I'm Howie Lim. This is Money Hacks by the Business Times. The surge and palpable excitement in equity markets at the end of 2025, while thrilling, risk clouding investors' judgment, potentially eroding returns. Bull markets frequently trigger mental traps, especially when prices climb excessively fast. A prime example is the mistake of equating a high-quality company with a sound investment. The crucial question is, how can retail investors effectively safeguard themselves against these pitfalls? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And joining us today is Jose Mayora. He's an author and also the founder of Divita Value-Growth Fund. Jose, thanks for joining us today.
Thank you for having me.
So given things are really expensive now, it's priced for perfection, what's one actionable valuation metric that we can focus on? A simple way, I suppose, we could check a stock's value instead of fancy ratios and such.
Absolutely. I think I would say two things. One of them, which is a shorter answer, is you have to check whether there's a history of compounding from the company. You got to make sure that if the company is retaining earnings, which most of them are, those that are public, and not paying dividends, you're going to want to see that their cash flows are growing over time at a decent rhythm, because then that means that the retention of earnings put into the business, into new projects, new endeavors, or whatever, is actually bearing fruit. And then that's how they're growing their business as a whole in an increasingly cash flow producing manner. And then the second thing I would add is you have to understand what are the growth expectations embedded into a company's existing market valuation. Compare what are the growth expectations embedded in the price today and compare those to what expectations you think you personally have. If your expectations are higher than what's embedded in the company's price, then that's when you could potentially have something undervalued. So it doesn't have to be as complicated as price to cash flow ratio, price to earnings ratio, and some of these other metrics. It can just be focusing on a framework that's much more intuitive.
You also always say that real money comes from letting cash flows grow over time. If a regular investor or saver doesn't have a lot of money to begin with, then how can they spot companies that are great at using their money because they don't have a concept of that at all?
No, absolutely. And it's a great question because it's important for every investor or aspiring investor to take a step back and ask himself or herself what type of investor they want to be. They can either be a passive investor and invest in ETF, passive index, the S&P 500, or whatever they want, or they can be active investors. We're not talking about significant amount of money and it's just regular savings to be grown over time. It's probably more worth it to go to the passive side and dollar cost average over time in an index. That's what I would say for most people. If, however, you feel like you have the stomach to invest in individual companies in a more active manner, you have to make sure that the underlying business in which you're investing is actually compounding its cash flow producing power. Because if it does, despite of the volatility of going up and down, you'll be compounding your wealth in the long term because the market's going to reward that. If, however, you find companies that have, I'm inventing this, $1 billion in cash flow today, and that's the same type of cash flows annually that they had 10 years ago, and they barely paid any dividends, that means they're in a defensive mode, that they're simply retaining cash, retaining earnings, but to defend their existing cash flows, not to grow them. And so in that case, you're not having kind of like a return on invested capital and you're not compounding at the underlying asset level. And so if that happens, you're never going to be compounding at the stock level in the long term. So there might be, again, some ups and downs over time, but you'll never be growing it consistently if that's the case.
What about, Jose, say a more established investor, if you will, someone who has a bit more experience? What's the biggest behavioral pitfall you see them suffering from that's been made worse by social media as a result of all this hype and so on?
The biggest mistake is conflating a good company with a good investment. It's relatively easy, in my opinion, to find a great company. We kind of all know them, those companies out there we actually use on a day-to-day basis. But at the end of the day, whether you're going to get a good long-term return on that investment doesn't depend exclusively on whether the company is great. It depends on how much you're paying for that company. Because even the greatest company in the world, if you pay $100 for every dollar of cash flows is producing today, it would be the equivalent of kind of like buying an apartment that gives you a rent of 1% of the value that you're paying for it. So how are you going to get a 10% return over time when the yield on that asset is only 1% in my example? So sometimes great companies are already priced to perfection, especially in contexts like today where there's a lot of hype. And so you have to be very careful of not mixing those two. And ironically, sometimes you might be better off investing in a so-so company that's a lot cheaper relative to what it produces than the great company. That's not always the case, but again, it's two factors. It's how good a company it is and how much you're paying for it. And the balance between those two is kind of like the art that you're trying to achieve when you're doing investing in the right way. And mostly if you're investing in the long term. Like if you're trying to do momentum driven type of strategies, trading here or there, you can make money with any sorts of names if you're good at it, but that's very difficult to achieve.
Give us an example, though, a great company, a common one that you believe is currently a poor investment.
Yeah, I think there's a lot of them actually because we're in a very healthy market. But just to name two, I would say Tesla and Palantir, for example. They're both great companies. I mean, I don't know much about Palantir. I wouldn't consider myself an expert, but I do know Tesla quite a bit. I'm a big fan of Elon Musk and the company itself, its brand, etc. Even though it's been a little bit damaged recently because of his political kind of activism, but still, I think it's a great company. But Tesla's price to cash flow ratio today is in the realm of 80 to 120 or somewhere. And it just goes back to my earlier comment. The things that need to happen in terms of growth and reinvestment returns of the earnings that they put back into the business have to be miraculous. And I don't like to invest in things, and I don't suggest people to invest in things that require somewhat of a minor miracle to happen for you to get your money back. That's one example. But again, there's many. I would say it's tough to find today a great company that has a margin of safety built into them. There's some out there that I would argue are fairly valued, and that's not necessarily rare. But I try to tell people that they should always focus on buying with a margin of safety so that in case their expectations are wrong, they're not going to necessarily lose money because they bought with at a lower price than they thought it was worth.
What is an undervalued one you think right now, as in people are overlooking it?
Well, one example that I could give, and I just do the caveat that this is not stock recommendation, people should do their own research, is Luckin Coffee, for example. If you think about the growth rates that they've been having and the executions they've had initially in China, but I know they're also making an entrance in Singapore as well, it's significant. And yet the valuation is very, very, very cheap relative to what they're actually achieving. So I think that's one example.
Still to come, which sectors or industries are chronically undervalued at this point? And if you're just starting out, what's more critical to long-term success? Optimizing investment selection or optimizing savings behavior? More with Jose Mayora in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. Jose, we're always told as retail investors to diversify, diversify, diversify. That's your hedge against anything that happens in the markets, etc. What are some other less obvious ways retail investors can protect their money when, say, profits quickly disappear thanks to a new breakthrough like AI or whatever's new on the horizon?
Maybe a couple of things. One is try to avoid following the noise and the media hype because you may be taken to the wrong path and the narrative can change in the blink of a second. So if you're following a narrative, it suddenly changes. What do? You have to try to have a more independent mindset and try to make your decisions based on a certain level of research that's independent to yourself. And you have to only invest in things you really understand because it's very easy, again, to fall into the hype and all the media noise and think that you understand what a company like NVIDIA does and why it's so important. But if you don't understand the underlying risks that it has, because you don't understand the competition, you don't understand maybe the industry cycles and things of that nature, you can very easily think that the recent past is indicative of what's going to happen in the future. And so if you extract recent trends to the future, you can make big, big mistakes. And I think a good example of that would be the company we're communicating right now on, which is Zoom. Back in 2020, in the pandemic, it was growing so much because of the adoption that it was really easy to fall into a hype and thinking that the north of 50% growth rates that it had were going to continue forever. But once things started to change and competition started to emerge with Teams and Google Meets, etc., then reality kind of hit, and the correction in that stock's price has been very, very strong, and it's unlikely to recover in any meaningful way from the peak that it had. So have to be very careful and only invest in things that you really understand and you understand the underlying risk that they have.
Since we're not chasing media darlings or market darlings anymore, where do you think we should be putting our money? What kinds of companies, parts of the market really that might offer the best deal?
But it's maybe easier to start answering that question where not to look. You know, try to avoid the sectors that are most talked about in the media and where there's a lot of hype, because those are typically the sectors that have a lot of optimism. And when there's a lot of optimism, the extrapolation of recent good performance is taken to infinity by many investors in the market. And so I would say avoid those. And you can look at other sectors that are maybe more boring, but that are, by that same reason, often overlooked. So you can look at like insurance companies, for example. Many of the insurance companies right now are reasonably valued, and I believe that there's at least a couple that are significantly undervalued. You can also think about it from a geographical standpoint. The US right now is a market that, because it's the epicenter of the AI trade, it's very hyped in general. And because asset prices trade on a relative basis, if things are overvalued in the hype sector in one country, that kind of pushes prices up of all the other alternatives because people are trying to find on a relative basis what could potentially be better, right? And so I would try to, in general, avoid the US, not totally, because the US is a great market, but at least be very careful. And maybe you can look at other countries such as China, where there's still, even though it's gone better over the past 12 to 24 months, but there's still a lot of fear of China being, quote, uninvestable. And so when there's a lot of fear, there's more likely the chance that you can find hidden gems in those countries. Of course, you have to be very hesitant in terms of potentially geopolitical risks and things of that nature. But I believe you can find quite a few hidden gems in markets like China.
What about sectors, though, that people are seriously underestimating right now?
Insurance, I also think oil and gas is a sector that in general is underinvested. And a particular sector I like significantly within our niche, within the oil and gas sector, is the midstream companies, the distributors of oil and gas in the United States. You have to be careful because there's some tax considerations for foreign investors, so it might not be for everybody. But that sector is completely underhyped, and precisely because there's some tax considerations to be taken into account, it tends to detract away a lot of investors because they don't want to do the hard work to figure that out. And so there's a lot of, I think, undervalued assets in that space that are completely hidden by 99% of investors, for example.
Okay, maybe we should step back and, as an average retail investor, not think about stock picking. It all seems a bit too confusing. Would you say that's advice you would be giving someone?
Yeah, and I think a better strategy is to dollar cost average. This is for most people into an index. And dollar cost averaging is very underhyped and underrated, but it's actually a great strategy because you're essentially committing to invest every 1, 2, or 3 months or whatever time frame you pick the same amount. And so what happens when you do that, say it's $1,000, is you're buying, sure, in parts where the market may be at its peak, but you're also buying into parts where the market is at its bottom. And the beauty is that because it's a fixed amount of dollars that you're always putting into it, it places more weight when you're on how much shares of a specific index or ETF you're buying when it's going down. than when it's going up. And so your weighted average kind of gears towards the bottom markets. And so that's a very good way to increase wealth over time just by doing that. So that would be my advice for most people. In some occasions, it can be accompanied with maybe making 2 or 3 investments in individual stocks that for one reason or another, that retail investor knows the company very well, maybe because it's in the industry they work for, or maybe because they're a customer and they know the value that it brings. And if the valuation is reasonable, the long-term potential is there, and that retail investor understands the business, I think there's a case to be made to concentrate part of their wealth in those 2 or 3 businesses, provided that they think about it on the very, very long term. And so they can kind of do a combination of those 2 things. But I would very rarely advise somebody to try to actively pick stocks and that be kind of like their overall portfolio. I think some passive portfolio is a good idea for most people.
What, in your opinion, then, is the best balance between the picking the absolute best investments or just being really good at saving money regularly?
Obviously, both are important. If you're going the passive route, the saving regularly is much more important. Just maintaining that discipline is at the end of the day what matters. And you have to be very careful not to be afraid when the market's going down, because that's when it's most important to continue putting money into the market. And that's where a lot of people make that mistake. They lose that discipline and they're only buying when things look good. But when the things are not going well, they stop buying. And so ironically, that hurts the returns in the long term. But if you can maintain that discipline regularly, that's the best thing you can do.
What about if interest rates keep jumping around, for example, right? So how much money should we be thinking about saving? Should that change because inflation's going to erode what our money is worth as time goes on?
In the very, very, very long term, I don't think it's an important consideration for most people, especially if they're passive investing and dollar cost averaging. But there can be certain sectors that are very sensitive to those type of macroeconomic factors. And if you're investing in those sectors, whether because you like the sector itself or a company within the sector, you definitely have to be very careful about what you're doing. And I mentioned, for example, a potentially undervalued sector in general could be the insurance sector right now. But one of the things there is that if interest rates go down, the investments that they make with the insurance premiums they receive is going to have a lower investment income. So if you think that interest rates are going to go down significantly, you do want to take into account that there's that cyclical nature of that part of their income stream, right? So it's definitely important to take it into account when you're doing active investing, but only to the extent it affects those individual companies. If not, I would say try not to focus too much on those type of micro factors because they're very, very difficult to predict. And at the end of the day, in the long term, they're not what's going to move the needle for a particular investment. What's going to move the needle for a particular company is their competitive advantages, their ability and capacity to reinvest their earnings in good projects or in new geographies or new products. And regardless of what happens with the macroeconomic environment or interest rates, if that company does well over time, the stock performance is going to do well over time. And to the contrary, if the company from the competitive advantage standpoint doesn't do well and it doesn't perform, regardless of whether interest rates went up or down, it's still going to do poorly. So that's kind of the mindset that I think investors should try to have.
I wish we had more time, Jose. Thank you so much for your insights today.
No, thank you very much for having me. It was a pleasure.
Jose Mayora is an author and also the founder of Divita Value-Growth Fund. This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.